Again, what did you think of the session in general?
James, traders really keeping their powder dry ahead of that key Greek austerity vote, and I guess that's going to be the key for markets this week, whether or not we see that passed. And it is a question of whether we're going to see a disorderly default from Greece or an orderly one. Of course, markets hoping for an orderly default, but that's the key risk at the moment. So a lot of people sidelines, and if we have a look at the volumes reflecting that only $4.7 billion worth of stock being traded. If we have a look across the sectors, the banks had a good session, though, bouncing back ahead of that austerity vote, and I guess some bargain hunters coming in there. Healthcare also bouncing back strongly. In fact, it was the best performing sector, but of course just making up for the losses yesterday where it was the worst performing sector. And energy coming under pressure, down 0.8% after oil prices hit a 4-month low overnight. But in the Asian session, we have seen oil prices climbing. So altogether, you can't really read much into this session except to say that a lot of people are on the sidelines waiting for this Greek vote.
On the broader index, is 44.51 still one of the major ones to be keeping an eye on?
44.51 is a key level, but when it comes to levels and trends on the market, really in the face of a key macro risk like the Greek austerity vote, these levels don't mean anything. And that's really why traders are sidelined, because the result of this vote could see a big reaction in the market, and we could see an inflection point or a new trend or a new era on the market developing. I guess the best case scenario is that we do see this austerity vote being passed, and that would pave the way for the 3rd of July Eurogroup meeting. And that would, I guess, pave the way for a plan around a 3-year bailout. Now, this 3-year bailout would mean that Greece doesn't have to access the bond markets for 3 years. Of course, this would be the second bailout. The first bailout was about 110 billion euros, and that was when the Greek debt situation stood at 300 billion euros. At the moment, the Greek debt has blown out to 340 billion euro. Now we're looking at a second bailout of about 110 billion euros once again. So if we have a look at the consequences of this parliamentary vote not going through, then we would see a bit of a vacuum in terms of the political landscape in Greece. Greece would then have to go to the short-term bond markets or look at a bridging loan from the EU to cover its next debt payment of about 12 billion euros. And of course, that aid payment is due to come from the EU IMF. So altogether, this vote is going to be crucial. If we do see a no vote, that could be risk off for the markets, because that would increase the probability of a disorderly default by Greece. And I think Mervyn King put it well last week when he said this is not a crisis of liquidity, it's a crisis of solvency. Greece is going to default. It's just a matter of whether we get an orderly default or a disorderly one.
I was talking about the banks today. Is it an area that you also like?
If we have a look at the banks and the reason why the dividend yields are so high, it's a very easy answer, and that's because share prices of the banks have fallen so much. And I think over the last couple of decades, investors have gotten used to very strong revenue growth, strong dividend growth from our banks. In fact, in the last decade, we've seen double-digit mortgage growth. We've seen easy access to liquidity from offshore markets, and we have seen very strong revenue from the banks coming through. But if we have a look at what's happening now, our credit growth is in the single digits, in the lower single digits, looking quite anemic. Funding costs have gone up because they've been trying to diversify their funding mix by getting more deposits, which are a more expensive form of funding. So that strong revenue that we've seen over the last 2 decades and have become used to is disappearing. So a key challenge for the banks is going to be cutting costs, and I think this is what we're going to see over the next year. We're going to see those banks focusing in on cutting costs because they don't have the strong revenue growth coming through. Credit conditions aren't looking so great. So while the dividend yield is looking fantastic for these big 4 banks, remember, it is because the bank share price has fallen so much, and I think the share prices of these banks have fallen so much because they do face some key challenges.